Hello, everybody. Thanks for joining us today. Hey, we're going to get started in just a second. As with all things COVID related, we have a little technical difficulty. So we're just waiting for Clayton Collins from Housewire to hop on, and we'll get started here in just a second. I think what we'll do is, while we're waiting for Clayton to get going, we will go around the horn and let's get the panelists introduced. And I just want to start by saying that this topic is a very important one to us at Builders Capital, to bring this information out to our clients. Whether you're a builder, fix and flipper, real estate agent, or an investor, this topic, we haven't had to deal with this for some time. You know, coming out of the downturn, this was a hot topic. What's the mortgage market going to do? How can I move my product? How do people qualify? And we've been spoiled probably for quite some time, and until this came along, and now we're facing some of those same questions that we did back during the downturn of how do people qualify? What's the buyer pool look like, and what are the adjustments have been? So that's what we want to cover today, because we think this is a hugely important topic now. And it's one of those things that a lot of people don't think about, why you're in the process of getting permits, getting through the project, building. And it's the last thing, but probably the most important thing that you need to understand is, how do I sell my product? Who can buy it? What do they got to go through to qualify? And how do I set myself up for success? So we'll go around the horn. Well, I'm Mark Woodbrige. For those of you who don't know me, I'm the Director of Sales here at Builders Capital. And we have a great panel, I think, to cover this topic. I want to say thanks to Jeff on Nostran at Movement Mortgage. You can see Jeff, right here in the red hat, or I think it's this way. He helped us set this panel up. But I'm going to go around and let everyone introduce themselves and tell us a little bit why they are on this panel, and a little bit about them, and where you are in the country too, because we got a few of us spread out all over the place. So let's start with Joel Epstein. Joel's got quite an interesting background in this space, so I'll let Joel tell us where he's at and give a little background on yourself, Joel.
Okay, great. Just before I do that, just from a technology thing, Clayton, are you on?
Hey, Joel, how's it going?
Okay, so by the way, Mark, Clayton can hear, but he's texting me he cannot get the video to work, and then I'll introduce myself. I just want to tell you that real quick.
Great. All right.
Yes. Welcome to our world. Hey, everybody, I'm Joel Epstein. I've been in the mortgage real estate industry for 30 plus years. They let me in when I was 5. You guys can do the math on that. I've been producer, owner, mortgage company owner. I've done every job in the mortgage business. I've been coaching and mentoring real estate people since '97 and mortgage people since 1994. I do also, in my career, when I was originating loans, did lots of builder end loans. So this is a great subject and great group for me as well. I'm constantly talking to agents and lenders all day long about what's going on in each specific market. I happen to be in DC Metro. I'm in Rockville, Maryland, right outside the DC line, maybe 8 miles from the DC line. For those of you that are in this market or know this market, I think that I have a very good pulse in what people are talking about state to state, even though each state is handling things differently. So hopefully I can add some good things today, some good takeaways for you.
Great. Thanks, Joel. Welcome, Clayton. Sorry we can't see you, but appreciate you jumping on. Love Housewire. If you guys don't have this publication, you should log in and get signed up for their daily updates. It's phenomenal. But Clayton, go ahead and give us a little background on you and Housewire. And thank you for coming on.
Yeah, appreciate it, Mark. Sorry about the video. I think our privacy settings are blocking GoToWebinar. But thank you all for having me. My name is Clayton Collins. I'm the CEO at HousingWire. HousingWire has been around for about 12 years now, covering the mortgage and real estate market. I joined the company a little over 4 years ago now, after starting my career in New York at Citigroup and Royal Bank of Canada, and investment banking and retail banking. And at HousingWire, we're highly focused in this time of change and turmoil on keeping real estate and mortgage professionals as informed as possible on the policy changes, demand, supply, interest rates, products, everything that impacts a housing professional's ability to serve their clients and homeowners. That is what we're focused on. We're a digital-first publisher. We have an independent newsroom of reporters and editors who are covering everything that happens in the market, and we do our best to stay in touch with our audience through our website, newsletters, podcasts, print publication, pretty much every format you can think of. What we are dedicated to the housing world.
Great, thanks, Clayton. Like I said, I get your newsletter every morning. It's the first thing I read. Great updates on what's happening, and I highly recommend looking into that to keep yourself informed. Curt Altig, would you like to introduce yourself? I know you well, so Chairman and founder of Builders Capital. So, Curt.
Right. Thanks, Mark, and Joel, Clayton, Jeff. Thank you so much, for doing this. This is the second, I think, webinar that we've done, and probably the third or fourth piece of content that we've put out. And, one of the things that's really important to us is to educate, keep people current. It flows with our brand promise of being a valued relation, a valued relationship to our customers. So thank you. So as Mark said, I'm Curt Altig, the founder and chairman of Builders Capital. 29 years, I was trying to do the math as Joel was talking, but 29 years in the mortgage, 29 years in real estate finance. I live here in Seattle, our company headquarters, born and raised in the state of Washington, and spent my first 18 years in the mortgage banking business. The majority of that, other than the first few years of producing, was responsible for building and growing branch and or state, regions, divisions for national mortgage banking firms, and had a heavy concentration in the home builder finance space through First Horizon Home Loans, my previous corporate employer, and then through the credit crisis, I had the idea to found the company, and here we are 11 years later. So happy to be here. And again, thank you all for joining, and thank you, Jeff, for your inspiration to put this together.
Absolutely.
Thank you, Curt. And last but not least, Jeff on Nostran. I've known Jeff for quite some time. He's probably one of the most passionate guys about the mortgage business I've ever met. And he has his unique brand with his hat and his beard, but love Jeff to death, and he is a fighter. So Jeff, tell us a little bit about you, and then we'll get on to the questions.
Yeah, so Jeff Van Nostran with Movement Mortgage. I grew up in Vancouver, Washington, Southwest Washington. I went to the University of Washington and graduated in 2005, put down roots in the greater Seattle area as an adult, got married, had kids, and life just got chaotic, and we decided to do something drastic, and we moved ourselves to Southern California. So I'm coming to you from Fullerton, California. We're about 20 minutes away from Disneyland, and still make frequent trips up to Seattle, although I'm missing it quite a bit right now because I can't get on a plane. So I look forward to seeing you guys in person sometime soon, and just really passionate about helping people. At the end of the day, I'm a total numbers nerd and a mortgage nerd, but I'm passionate about helping people, and mortgage financing is a way to impact a lot of people's lives with the biggest financial decision for most people in their life, and the largest debt they'll ever take on. So really pride myself on educating, teaching, and advising clients as well as business partners, so builders, real estate agents. That's what this is all about, is educating our colleagues and our team members, because every one of us takes a team approach to this sport. I know a lot of us are sports fans here, and we're probably missing those things as well, and you'll hear those analogies from me quite a bit, that we can't do this industry alone. We need each other. And so without further ado, let's dive in, Mark.
Great. Thanks, Jeff. So I appreciate everyone on the panel sharing a little bit of their background. At least you know who you're getting your questions answered by, and a wealth of information here, because data right now is so key. You keep hearing that on the news. We're following the science. We're following the data. It's the same thing in the real estate market. Everybody wants to know what's happening and when, and how does it affect what we do. And as I mentioned when I opened this is something we haven't had to deal with for a while. and the mortgage market adjustments and changes to it, but it has a major impact. So if you're not paying attention to this, you really need to. I'm going to start the first question to Clayton, and we got a lot of great questions, so I appreciate everyone that signed up to listen to the webinar. Thank you for your submissions. But Clayton, this question goes for you. You guys yesterday on Housing Wire had your title on the webpage was Mortgage Catch 22. Interest rates are lower than ever, but millions of borrowers can't get a loan. Can you please expand on that and talk a little about that headline?
Yeah, so there's a confluence of factors that are really making it significantly more difficult for borrowers to get a mortgage right now. And a big part of that is a flight to quality. And as we came into this COVID-19 landscape back in March and much more pronounced in April, we saw lenders from every different walk of life, from retail, wholesale, and community banks, start putting overlays on products and tightening the credit box. And for much of the last decade, we've seen that credit box just continue to expand and make the access to affordable mortgage credit broader and wider, not just for the perfect credit score, two earners, W-2 income. Like, it was opening up to entrepreneurs and people without a perfect credit history, some of that non-QM product, and all of that disappeared really, really quickly. And so even though we see interest rates coming down into, even some lenders announcing in the last week, dipping down into the twos, but I think that's still a little bit few and far between, it's not as easy as everyone thinks it is to go out and get that rate or get a mortgage, period. But that really is changing on a daily and weekly basis right now. We saw all of April spent with credit tightening. And the last week or so, we've actually started to see some lenders in some niches start to lift some of those overlays and start to open up that credit box again. And that's really the focus of that Catch 22 article. And I think it's really frustrating for a lot of loan originators and a lot of real estate agents as they talk to consumers who think they're going to walk into a lender and get a 2.75 interest rate, even though they have a spotty credit history, or they're going to walk in and be able to buy that dream home they have just because the cost of capital is really low and they're going to be able to spend more. If they've had any hiccup in terms of their employment, or they've been furloughed, or credit score isn't perfect, it falls kind of beneath that conventional limit. It's just not as easy to get credit right now. And that's something that's creating a lot of confusion for borrowers and homeowners and frustration for originators. But fortunately, fingers crossed, I wish I was on camera, so I'm crossing my fingers right now. It seems like we're starting to see some glimpse of hope and a little bit of loosening in the markets.
Thank you for that. So here's a question I got multiple different ways. This one I'm going to ask to Joel and to Curt. What changes have occurred in the jumbo mortgage market, and how long, if there's been changes, do you see those being in place, and do you think this will be the same in a year from now? So we'll start with you, Joel, and then we'll go to Curt.
I think it was Curt. You probably got your finger on this. I know Jeff does. I think it was about three and a half weeks ago, where Wells stepped forward first. Maybe it's 4 weeks. I don't know. I don't even know what day it is, if you guys are all experiencing that as well. Where Wells said, no more correspondent. Bye-bye. Thanks. Turn the tap off. You want a loan? Got to go to a retail LO. Citi went right behind, then Chase. Boom, boom, boom. So many of the correspondent lenders that obviously were packaging and selling loans there had an immediate challenge. And there were very few jumbo lenders sort of, I'll call it, left out there. Now, very quickly, people stepped into the space. What I'm seeing is you can get jumbo loans. Is it going to be the sharpest, craziest price in the house? No. If you qualify, you can definitely get one. Qualifying is the key word right now. Jumbo lending definitely has a massive flight to quality stamp on it. I think that's good for the audience on this phone, because who wants to spec a house like that and not be able to close it because the mortgage fell out? So some of the new requirements, whether it's having more cash reserves which again, is huge. Whether it's down payment, not as aggressive on the low LTVs, they can still get loans. I think if I'm a builder and I'm selling product in that range, I'm extremely zeroed in on who's doing that loan, where it's going, and the real quality of the borrower, not just, they're pre-approved. Curt, I'll throw it to you.
Yeah, I think you covered most of it, Joel. I did some surveying pursuant to a video we published, I think yesterday, a number of institutions, including the big banks, contacted my own loan officer on our loan, asking some questions. And it's interesting, absolutely tighter credit qualifying. The thing that I heard that I had read in an article but could not find again online were that the big banks are also requiring a deposit relationship. That is new, or at least new to my knowledge in the last decade. But just like anything that's in the non-agency space, there's not a common kind of clearinghouse anymore. In other words, a standard mortgage broker isn't going to have access to all that product like they did 10 weeks ago. And so as a consumer of the product, you are going to have to be willing to go institution to institution to shop for price and term. And as a provider of product, meaning building homes that jumbo buyers are buying, you are going to have, in my opinion, a deeper bench in terms of your mortgage referral partner to ensure that that referral partner has access to product. Because again, 10 weeks ago, your mortgage broker could cover the market for you if that was the choice of your referral partner. And today, due to no correspondent lines, no third-party originations, that's changed. So,
Curt, I want to just hop on real quick. Deep bench. Everyone should write that down as a note. Everyone listening, deep bench is your lender partner. Even if something changes, are they good to go? Again, nobody wants to spec a jumbo house because they can't just get money to that borrower. So, it's not, I just want to make sure you heard Curt say that, because it was a great word. How strong is the loan officer and the lender that you're dealing with? What kind of bench do they have? You got to go one layer down to make sure you can deliver your product at the end. Sorry, Mark, I saw you going in there. I just wanted to key on that. I thought it was
that's okay. That's
very
okay.
important.
Because I think that this is all in the same vein. And Jeff, this question is going to go to you. And it's talking about, I've been asked this multiple times in different ways, but it boils down to qualification. We've got record unemployment. We've got people being furloughed. You have people on unemployment still making money. You have people furloughed, but they're not at their jobs. So how are lenders handling that verification of employment? And do you have any idea how they're looking at income for furloughed or unemployed people?
Yeah, I mean, for the most part, the same policy for furloughed employees and unemployed people is in place today as it was in years past. Those guidelines have never changed. We in the mortgage lending industry demand that there's a stream of income that can be relied upon for the qualifying and approval of a loan. And so the job history has to be there and the income has to be there, but the income that is there has to be tied to showing up for the job. So, I'm not picking on anybody. Nobody's ever picking on anybody. These are just objective black and white guidelines. You have to be employed and you have to have that stream of income, plain and simple, because what's going into our mortgage file, pay stubs, W-2s, bank statements, tax returns, and we're looking at that data on the documentation. And a home buyer is only as good as what they can prove on paper. And if those pay stubs stop showing up and or future pay stubs start coming in and half the hours are there, we can't give them the same loan today that they could get weeks ago. Does that answer your question?
Yeah, I think there's a lot of what do the qualifications look like as far as questions are concerned. And we'll get back to some of those specifically, but I'm going to jump to the real estate market real quick. And this question's going to you, Clayton, and to Joel. Traditionally, the highest selling season is spring. Since we did not have a spring selling season, or looks like we won't for the most part, what do you think the impact can be long term, or will this correct itself over the summer?
Clayton, me or you?
I can start us off. We've had a few interviews with the chief economist at House, Ralph McLaughlin, in the last week. And one of the things Ralph is, everyone's got a different view here, but one of the things Ralph is focusing on is a flying W-shaped recovery. And we're in the lull of that first left side of the W, and anticipating a lot of pent up demand coming into the summer as people who would have been in the housing market in the spring are just getting antsy, sitting inside of their apartment or their home without a home office, and just ready for a change. And he and many others are anticipating a really busy summer buying season, assuming we get outside of this stay-at-home order, depending on what region of the country you're in. He's concerned about another fall lull. If we see a reemergence of COVID in the fall, as people get a little bit looser with their stay-at-home practices, that could really impact real estate agents' ability to show homes and open houses and showings and actually get inventory out there. But ultimately, the messaging is that people that have not been furloughed and that have maintained their income, and this certainly, unemployment has not impacted the U.S. Unilaterally or equally. Like, there are certain job categories, specifically white-collar, high-income job categories, that are still very much employed and very much making an income. And those categories, depending on the region of the country, could be really strong in the summer and throughout the fall because of this pent-up spring home buyer demand, and the antsiness that comes with realizing that your home is no longer just a place you sleep, but a place that you kind of run your whole life out of. And that demand for an extra bedroom or a home office or an in-law suite could only be increasing for certain demographics in the United States.
I'm going to be even more bullish than Clayton. Clayton's on my call every Tuesday, so he hears how bullish I am. Number one, January 1, we started the year 3 million houses short. We were 3 million houses short for the pent-up demand for what people wanted. Rates were low. We thought we were going to have an early spring season. We all know the Easter Bunny is what everyone likes to list. That's what everyone likes to start doing transactions. We thought it was going to happen earlier. Rates are rock bottom. They're not going up anytime soon. Maybe they're moving a little bit in a small range. And then now we have delay. Now we have COVID. So I think we're going to have the spring market this summer. I'm basing this on what I know and who I'm talking to in all different areas, with the exception of the state of Pennsylvania, which is on full lockdown. The agents are out in hazmat suits with Lysol wipes, bringing the heat all over the place. They are selling houses. Okay. They're definitely selling houses. The loan officers that I work with, like Jeff, I only work with elite top producers. These people are extremely busy with new purchase contracts. Most people also canceled their summer vacation. They wanted to make sure they didn't eat their deposit. So they canceled their summer vacation. The reason the market's slow in the summer is not because it's hot. It's because people go away and they don't want to transact business while they're gone. Okay, so now they're home. The rates are low. There's pent-up demand. States are opening right now. And then what Clayton was talking about, if you call people that you know, pretty much everyone after the first White Claw or Prosecco at 5 o'clock every night is looking at each other across a table, unless they're very blessed to be in a big house going, yeah, this happens again. I don't want to be in here. I want to be out. I made a joke to Curt when we were talking earlier this week. I said, if I was a builder, I'd be redoing a lot of my plans to soundproof the offices, literally sell it. This office is soundproofed. So you don't have a kid, and I'd put a lock on there too, so your kid can't open the door and go, can you make me a grilled cheese while you're in the middle of working? Because everything is going to be home centric. So to be in the business we're in right now is phenomenal. The next couple of weeks is really going to let us know what's going to happen regarding the W that Clayton was talking about. The big factor is vaccine. But the reality of it is real estate agents are very industrious people, and they are the ones writing the contracts on the homes that you all are building right now, for the most part. They're the ones writing the contracts, and they have buyers and they're out. Mark, I don't know if you want me to hit this, but on what Jeff was talking about pre-qual, the trending on the pre-qual, do you want me to hit that right now while it's fresh?
Yeah, go for
it.
Okay,
so what I'm seeing
major
as a trend across the country, everyone, is sellers are not allowing prospective buyers into their homes unless they are completely pre-approved. They do not want to disinfect their house for a tire kicker. Okay, so how does that translate to the building industry? Whether you are delivering a product in 2 months, 4 months, 6 months, 9 months, 12 months, I don't know what you're building. Okay, but you have to be very, very on it with how the people are qualified that are buying your stuff. Now, what's interesting is this is not a quick 45-day settlement for the most part. I mean, I know some of y'all have product you could pop and move immediately, but our lenders' documents expire. If your lender is not redoing the docs, literally reprocessing these loans every 45 days, you're working with the wrong lender partner in this kind of market. You could end up speccing a house. So gone are those days where you just take a contract because the house is so cool. You're like, if it falls out, whatever, I'll sell it to someone else. I think that those days are over. And I just wanted to hop on there with Jeff. Sorry, Mark.
No, that's all right. Jeff, let's stay with that thread a second, because that's one of the questions we have here is, a lot of our builders will start a project pre-sale and get a pre-approval letter. And we're evaluating that ourselves as their primary lender currently is, okay, what do we need to do different? So now that guidelines have changed, credit's tightened, what do people need to do differently when pre-approving a buyer?
Yeah, man, there's so much to this topic. Over the past, 10 plus years, the economy has been so strong and housing values have been appreciating. And I think that many of us lenders, real estate agents, builders, we've all gotten complacent. We're guilty to some extent of, well, somebody was able to furnish a pre-approval letter. So, but let's wrap it up. We're good to go. Right. And a lot of times that piece of paper, it's not even worth that piece of paper that it's printed on. That pre-approval doesn't mean anything. It was given out to a home buyer based on a conversation, right? So I think the real question is, what level of vetting is going into the issuing of that pre-approval? Are we talking about an initial application? Are we talking about a credit report being pulled? Are we talking about getting income documents and asset documents? Are we proving all of these qualifications on paper? And even after gathering all of these documents, right? I'm a loan officer. I'm passionate about helping people. I want to spend all day, every day on the telephone with people. I don't like living in the paperwork world. So I need to have a team behind me that's equally as passionate about the paperwork side of it, so that we're getting the full vetting done on each file. And so I want to make sure that every builder is working with a lender that is doing this level of vetting and working with a rock solid team that is going to run people through the ringer before they go mutual on a house. Because the days of a loan is a loan is a loan, those are over, right? You don't hear me saying, oh, go look at ABC homes and XYZ homes. A home is a home is a home. I hope every builder on this video takes offense to what I just said, because you're all super prideful about your product. You are super prideful about the home that you build and the quality of home, right? And on the loan side, a loan is a loan is a loan is disrespectful to me. No, there is a financial product, a 30-year fixed at the end of this process. Sure, the product itself is a commodity, but the speed, the service, the communication, the expertise, we are not all created equal. Loan officers and mortgage lenders are not created equal. And I think this is a great opportunity for you to be the general manager of your football team. And right now it's the off season. Just for a split second, it's the off season, and you have an opportunity to make upgrades to your roster. Who is on your team?
I told you at the beginning of this, Jeff was really, really passionate about this. So there you go. It is a contact sport for Jeff. So I get that, but it is important because right now, what are we facing? We've got larger down payment requirements. Credit scores have gone up. Loan programs have disappeared or tightened up altogether. So those are all the concerns. And so Curt, this question goes to you. When that happens, you and I are living this every day, but this question came in multiple times. If the mortgage market changes, how's that impacting private lenders? What are companies like ours having to do to adjust to what happens in Jeff's world and Joel's world?
Yeah, so, again, the private lending world, let's just talk about that in the context of the entire non-conforming space, right? So the benefit of the conforming space is that it's a highly liquid market. The Fed has, time and time again through the Great Recession, I can hardly remember, 9/11, but there was significant disruption after that. There was disruption during the dot-com boom, and there's been disruption amidst COVID. And the Fed has always ensured that the mortgage market, while it might be dysfunctional in a way that of like the changes that we've talked about, the product is still there. It is still possible to get a loan. You're just going to have to work harder for it. On the non-conforming side, which affects private lenders, what happens when something like this happens is that it dislocates it even further. In other words, at least on the agency side, you have the consistency of Fannie, Freddie, and all the Ginnie Mae, FHA and VA product that's set at kind of a national level and then trickles down, throughout the lender network. It's not that way on the private side. Most of these companies, and we're one of the larger in the country, particularly specialized in the construction space, is we're reliant on very bespoke financing and capital structures behind us. So without going off on that tangent, I think the impact is going to be, and you're already seeing it, there is lenders have generally pulled back to assess what's the where's my financing at? What capability what do I need to provision for in the short term, given that I'm in a marketplace that is not as liquid as the conforming space? And then assessing what can I expect as we come into this summer and fall market with respect to where's the economy going to go and where's housing going to go in general. So I think you're going to see increased pricing fairly significantly on the non-conforming side in general, and that's going to be true to private lenders. As we sat here, Mark, as you recall, a couple hours ago, an email came across from a lender just broadly advertising with fix and flip pricing at 10 and 3.5. 12 for 80% LTC, which probably is a 65, maybe 70 LTV max. Now, that is probably 200 basis points in rate higher than it was 10, 12 weeks ago, and probably 150 basis points easily higher, on the discount or on the points, discount points, if you will. So again, I think that those that need private lending, no different than what we just advised a few minutes ago with respect to mortgage lenders, you need to have greater depth of access. You need to have bench strength. You need to have more resources, more relationships. And I think we're going to see that continue. My prediction is that, as is almost always the case, the conforming market will come back first because it's more well-heeled than the non-conforming. And within that non-conforming space, I certainly include private lenders.
All right, thanks for that. So I'm going to combine a couple questions because the theme on these as they come in are similar. So this is going to go to Clayton and Joel, and it has to do with, I've got a few questions from builders and some fix and flippers. They're saying, in what, in your opinion, what type of product and price ranges should we be focused on? What should we stay away from? And one question that lines into this is like urban living. You think that's going to diminish as you're seeing all this change? Because I think our way of life is going to be adjusted, whether we like it or not, going forward. And Joel, you had mentioned the other day about, dual home offices and things you might see builders or design do because people are realizing they can do this. So the broad question to the two of you, and maybe we'll start with you, Clayton, is if I'm an investor or builder, where would you be in your opinion, or what would you stay away from?
Yeah, I mean, that's a tough question that definitely varies a lot by region. And I don't think we have time to go through every MSA right now. But a few of the things that we're hearing at the national level are an increased emphasis on space. So like Joel has said a few times, home offices, and we're also seeing an increased from polls and surveys, increased interest in multi-generational living. I think this has been trending for a little while now in specific demographic groups, but with assisted living facilities being a kind of hotbed of risk during COVID, this has kind of been a home interest category that's been popping in Google search results of homes with space for an in-law suite or a grandparent, so they can do aging in place opposed to assisted living. That's a few of the feature demands that we've seen, and that really kind of varies at a national level, like I said. But the one thing that is consistent across the whole country, though, is the homeowner vacancy rate, and that's a metric that our economics columnist Logan Mohtashami has been following really closely, and that rate dropped to 1.1% in the first quarter, lowest in 4 decades. Really almost a third of the rate that it was when we were going into 2008 at 2.9. So just a crazy time of super low inventory and demand across the board. But the Google search result trends are pointing toward more space and living situations where people can use their house as a home, not just a place to sleep.
What I'm experiencing, what we're hearing, on the street is all right along those lines. To get very specific, if I wanted to make sure I was batting home runs all day long, depending on the size I was as a builder, meaning how much inventory I could handle and how much heat I could take in a slowdown. I mean, if you stay in your market conforming, you stay starter, you stay 3-2 starter. That's what agents call it, a 3-2 starter, whatever that means. With a cool floor plan, there's a lot of people that wrote this out in apartments that, paying high rent and be very happy to get out of that apartment and into something bigger, with an interest rate of whatever, like a Jeff would give them, 3 1/8, whatever it is, or 3 1/4, or whatever the crazy interest rate is. Their PITI, their monthly spend is probably what they're spending right now. Curt, he said this really fast, and I'm sure most of you all understand and know all this, but sometimes, you're building homes, you don't totally understand, agency, means the government is going to buy it. They're going to be involved. And so those max conforming rates, that's all agency, VA, FHA conforming. We know the government's behind us. So, one of the safest things, obviously you could be building right now is anything in the conforming range. With that said, just to professionally confuse you, but wait a minute, there's a whole bunch of people that want to move up. So, depending on where you are, where I am in DC, conforming is what, a 1-bedroom condo 30 miles from here. It's a crazy market. You're not getting anything conforming here. So it's a tougher thing to answer. But the one thing I would say, to go right along with what Clayton said, is I would be getting very creative with my blueprints right now, because it is factual that most companies are now owning the fact that their people can work from home and be productive. Okay? If you have 2 people working from home trying to be productive, for the most part, unless one person wants to sit at the kitchen table, you need 2 office spaces, or you need 2 spaces where they can do that and hide from their kids, basically. I say that tongue in cheek, but it's kind of true. Most people are, one person's hiding in the basement, the other person's in the office. Everyone's dealing with the same thing. But I think that's huge. Layout, post-COVID, post-virus, blueprint layout on what you're building. Man, I'd be in the drawing board right now to get out ahead of everyone. And I said soundproofing, you all can laugh. Those of you that don't have kids, you're like, what's he saying? Those of you that have kids are like, yeah, please, can I be in a soundproof room? And I know that's a stupid, weird thing, but I think a consumer right now, if you said, yeah, the office is soundproof, they go, really? I think it's even a hook. that they would look at. So, Mark, I'll throw it back to you.
Joel, this is Clayton real quick. You know my story a little bit, but the last 2 weeks we sold our 3-2 to a couple from Philly who was getting the heck out of the Northeast and bought a 5 bedrooms. My wife and I would both have offices, and so we did that demographic swing to try to get space where we can work from home. But I still have Moana blasting in the background right now. So yeah.
Exactly.
Mark?
Guys, I can't hear Mark.
I can't either.
Well, I muted my phone because my kids were screaming in the background. So
there you go. Case in point. Yeah.
I would take a soundproof room, that's for sure.
Yeah.
No, it's great information because not only are we talking about the finance side, what do you got to do to look at things differently and be cautious as you're going to sell and making sure you have it dialed in, but two, what's the product type we should be looking at there? I've gotten a few questions on, what advantages can we find during all of this? And some of that I think is just a reset and rethinking of how you go out and do business to take advantage of this. And it's hard to say, hey, I want to take advantage of this situation, but we have to figure out a new path forward and a way to do business and get through this so we can get back to I guess, life as normal. So great answers. Appreciate all that. So here's one that keeps coming up quite a bit. And Curt, I'm going to throw this your direction, and a couple of you can hop in on this if you'd like. But do you see banks tightening restrictions or eliminating spec construction programs?
Yeah, absolutely. And how I would answer this, and if there are bankers, and look, I chose to leave the banking industry in general, if you will. Most of the mortgage companies that I work for were owned by banks. And I'm not speaking of the people, I'm speaking of the industry when I refer to bankers. But anytime there's a shock to the system like this, and again, you can go back to the dot-com boom, 9/11, Great Recession, and COVID, banks get hammered. They have to provision for loan loss. They have to take certain mark-to-market provisions on their book, and it puts a lot of stress on them at a time when interest rates have been low forever, and it's very difficult for them to make money, right? They're paying some pittance of a wage for deposits. They're making loans from low single digits to maybe mid single digits. There's not a ton of margin. And then to cap it all off, their primary audience is a regulator. And one of my business partners, I don't know if he coined the phrase, but first I heard of it was banks aren't in the business of managing customer relationships. Banks are in the business of managing regulator relationships. And again, it's not a personal attack on the people. There's some phenomenal people, and there are some phenomenal banking institutions, many of which we have partnered with and are partnered with today. But the reality of their environment is they're beholden to regulators. So yes, I think you're going to see tightening. You're hearing it already. I won't put names to this, but just this week, we were notified by a large customer of ours that their other primary banking source, of which is their largest, has suspended their line, and that includes current in-process projects. So that is the type of thing that you heard about back in 2009. To me, it doesn't matter what my opinion is, I guess, of it. It seems awfully quick. But again, it's a testimony to the magnitude of this issue globally and the fear of what shoe's going to drop next.
If I was, Mark, if I was building right now, obviously with a lender relationship, not out of my pocket, using you guys for financing me basically, I would be looking very hard at how solid every transaction is on every single house that I'm building. So if I had to go to the mat, I could prove it. Because it's not a spec anymore, really, when somebody's completely pre-approved. Yes, something bad can happen, obviously, but it's not a true spec when you just throw something else and hope it'll be sold. And, Jeff touched on this a little bit, and I think it's a strong message every builder needs to hear right now. Builders, it's been a great run. It's been awesome in many areas of the country. But there's a lot of builders where those site agents are just taking contracts, they're throwing them at the wall. If it doesn't close, they slide someone else in and it closes. That's pretty much over. And I would not be running my business that way at all. I would be coming down very hard on how approved the people are. Are they still approved when I'm looking at a pipeline? Do I have calls with the lender where I'm going back through every transaction and they're not just going, no problem, no problem, no problem. No. Did you redock it? I wish I could see every builder on the phone right now watching them nod their heads how many times they found out 3 weeks before settlement that something changed. And then they got a big problem because the lender pulled it out of the drawer 3 weeks before when they had to work on it. They apped it 6 months before. Very, very normal. That is not abnormal at all. And I think it's been very lucky and fortunate, as Jeff put very well. It's been an incredible run. Now you really got to look at that. I don't care how awesome your product is. I don't care how hot your market is. You better be looking at that. You better be looking at every transaction every month when you do your pipeline calls with your lender. And I think, Curt, tell me if I'm crazy, but if my bank, was coming down on me, and I had that kind of information, that's good stuff to have in a meeting to be like, whoa, hold on a minute. We're not just running fast and loose here. These are all sold. Yes, someone can die, but if they don't die, they're closing.
Absolutely. It's exactly the types of conversations we're having across, our portfolio right now. Verify, re-verify, keep it really, really tight.
Yeah, it's difficult too when you're chasing a trend, and this trend is changes and tightening credit requirements. And I think that's probably the biggest message of all this is we can't look backwards. We got to look at what's coming and what's coming forward. But we're coming up on the top of the hour. We were going to keep this fairly short, so I'm going to give you all a chance to just kind of summarize your thoughts on this, and we'll start with you, Jeff, and work our way around the horn and wrap this up. But once again, appreciate your guys' time. But any final thoughts on this? And I'm sorry to those I couldn't get to all the questions. We could be here all day, but unfortunately we can't do that. So Jeff, why don't you give us some final thoughts on this topic?
Yeah, I mean, selfishly, because I represent the residential lending space, I'm a big part of your exit strategy. If you're a builder, you're a fix and flipper, you got a house to sell, the mortgage lending process is your exit strategy. That's how you get paid. And you need to objectively evaluate your team members. Who are you partnered with right now? Because the strength of that lender, their ability to communicate, provide service, speed, re-verify documentation, all of those things, that is your quality assurance to making sure that you've got a payday. And one last kind of head scratcher that I was thinking about this morning is we're so tied up with our lifestyle, our toys, our cars, our boats, all of the things that we love and are near and dear to us. I think you're going to see a lot of Americans fighting to keep their stuff. And if anybody in the family has experienced a hardship with a job or employment or income, you might think about how credit utilization goes up because people are going to be using their credit cards to keep ordering out for food, keep their toys and not have to sell that stuff off and give it back. And as a builder, if it's going to take 3, 6, 9 months to get some of these people into a house, it is really important to re-verify this stuff because increased credit utilization is going to bring down credit scores and it's going to increase debt to income ratio. So people borrowing more and more, fighting the one of the two spouses is unemployed or something, can really drastically change the qualifications of a home buyer fast. So.
Yeah, no, good point. Debt to income ratios are definitely a concern and are going to change and getting tight. Joel, let's go to you. It seems like you got a friend on your lap. But
yeah, my wife decided it'd be a good idea to get a COVID puppy. So I've got a golden doodle here, and I'm going to need any of you all have puppy therapy. Find me at bigjoel.com. The dog hasn't been away from me in about 10 weeks, and I usually travel every week, 2 or 3 days. So I think the first day I'm gone, we're very concerned with this dog losing it. And I'm sure a lot of people are going through the same things. She's sitting next to me, and she just insisted on lap time. And again, maybe builders, you might want to add, pet stuff in the house as well. because I think all the shelters are cleared out. Everyone adopted every pet there was. I just want to say that I am very bullish. I know what you all do has a lot more risk than selling a resale house that is going to quickly close. But I really think there is a ton of pent-up demand, a lot of pent-up demand. I think what we're going through schwacked us in the head. We are the United States of America, which means the governor of Texas is the equivalent of the president of a country. We don't roll where the top of the house just says this is what we're going to do and we're going to do it. The governors really run the show, and because of that, it's a little wacky right now. They can't just impose shutdown on everyone and put the National Guard on the corners because governors won't allow it. On the other side, this is America. We dig out. We have grit. We make things happen. And like I said, we started the year 3 million houses short. Okay, where are they coming from? People still want to buy them. And as the economy, comes back, there will be a vaccine. I'll debate anyone on that. There'll be a vaccine, and everyone in the world's working on it right now. And as soon as it's tested and it's ready, and people start getting vaccinated, it's going to be game on like you've never seen. It's everyone here is in a great business, and I understand there's some short-term risk and some short-term problems. And Curt elaborated on a lot of things you got to watch now that you didn't have to watch before. But you know what? Big whoop! If you've been building for a while, you had to deal with this in 09 and 10 anyway. After the fallout of 08, it's not that different, really. And so, I would tell you, what Jeff said times 20. I would take a hard look at your lender relationships. I would make sure no one's playing fast and loose at all with pre-quals, with pre-approvals. Any contract that is ratified, that is agreed to, where people are writing checks for upgrades, whatever, you should be all over that stuff. And again, not allow these, once however many times you do pipeline meetings, if you're selling a lot of houses with your lender or lenders, we're good. Yeah, we're good. Yeah, we're good. No, nothing is good. No. Did you redoc that file? If you want to have a takeaway from me, write this down. Has that file been redocked? Lenders will hate me for telling you to do this because they don't want to do it. Okay. But the bottom line is they better be doing it to protect you, your investment, to protect your relationship with your lenders, to protect your lenders' relationship with their lenders, everything. You should be all about it. And I wouldn't be scared to be doing lots of business. I would just be very, very deliberate about how I do it. And I would not sell people houses that cannot buy them, period. That's over. And just want to thank everyone. Thanks for inviting me on. I don't know if my website is anywhere. People want more information. There's all kinds of podcasts. I'm glad to answer questions from anyone. If you have them, you can send it to info@bigjoel.com. And any questions you have, just say, "Hey, Joel, heard you at the meeting on Thursday," or whatever it is. And I'm glad to answer questions for you. So thank you. I guess we're going, Mark, back to you.
Thank you, Joel. Appreciate that. Yeah, check out their information. Like I said, great. These guys are looking at data all the time. Hey, so Clayton, why don't you give us some final thoughts as well? Maybe.
Do a real quick wrap up here. So Joel mentioned 08, 09. The one big difference that I think we all have to remember, and this is definitely confusion in Main Street America, is that the word recession has become synonymous with housing crisis. And we're in a very, very different scenario than we were in 08, 09. In that period, we were coming into a recession after a period of overbuilding, and now we're coming into a tough economics time, a health crisis after a decade of underbuilding. We came into the year with some of the tightest supply that this market's ever seen, and some very big and strong demographic waves that were just exacerbating pent-up demand and shortage of inventory. I've been pretty vocal. I'm I'll die on this mound. I think housing is going to be the industry that helps pull our country out of an economic recession, not a factor that makes this worse. We're going to have our challenges. We're going to have our difficulties. We've seen them over the last 8 weeks. You're seeing some of them now. But ultimately, in the end, housing is going to be a very significant player in the health of the U.S. economy.
Great. Thanks again, Clayton. Appreciate it. So, Curt, why don't you wrap us up and let everybody get on with their day?
Yeah. So thanks, Mark. And these guys covered all the high points. It's a challenging time. I love Clayton's last comment. I don't know how many times I've had this conversation in the last 10 weeks. 08, 09 was a crisis that many would say was caused by dysfunction in the housing market. This is a virus that has caused significant disruption at a capital markets level that is translated down to disruption, across lots of different markets and economies, et cetera. So we've got some challenging times ahead of us, but I think there's lots to be encouraged by. I won't repeat what the guys have already said in terms of the tips and what folks might do to better prepare for this. But I would also add that it's a phenomenal time for innovation, right? To look at and figure out, what can I tighten? What am I not using that I could be using? I was on a panel, I think it was last week, with 5 builders across the country, and I was the finance guy. And I'll leave you with this story. An individual in the Southeast, about 150 unit a year builder. They saw traffic fall off the second 2 weeks in March. I think it was about 70%. They had invested in virtual tours. They doubled down and added plan types and I think a second community of 3 to the virtual. They started pushing the virtuals. And what they realized over the next month, once they got that started, which took them through the month of April, was that traffic was off, depending on the community, 60 to 65%. Conversions of renovations went from 25% to almost 50%, and they were somehow able to track that the reservations were being made, the percentage of reservations being made by people that had virtually toured, anything over 2 was phenomenal. I don't remember the percentage, but it was resulting in a doubling almost of reservation to contracts. And they had written 13 contracts the week before and converted 6 of them to hard earnest monies. And he's back on track this year. So each market's different. I get that. There are other places in the country harder hit by this thing. I get that as well. But it's a great time for innovation. There's reason for hope. And I couldn't agree with Clayton more that I believe, unlike the Great Recession, that housing and specifically new construction will be a key contributor that brings us out of this. So thanks for Jeff. Thank you, another Mark. Thank you for and Clayton and Joel. Thank you joining us today. It's been awesome.
Thank you.
Great. All right. Thank you, everybody. Hope everyone took something away from this. Once again, appreciate the panel. And we'll be back in touch again here in the future with more information. And hopefully we can all get back to work sooner than later. So thanks, everybody.
Thanks.